Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. It's a Thursday morning. Lots to track from overnight. I mean, it's a full docket of stuff which is kind of sort of handed over. And it's not as if local news flow post-market hours is any less. So, I mean, it's full steam ahead. We are coming to you from the CNBC TV 18 Motilal Oswal studios. I'm Prashant, with me, my colleagues Reema and Nigel. Guys, good morning.
Hi, good morning. I, for one, am counting down to the weekend. Nigel is counting down to Valentine's Day and the end of the earnings season.
Yeah.
Well, that's right. End of earnings season, right? It's getting a little intense. So you look forward, actually. Tomorrow will be the final day. But we'll get past that. And to be fair, earnings season hasn't been that bad. But we're looking forward to better times. Q4 should be a stunner, if at all.
And usually the tail end is when we start getting weaker numbers. But this time, it's actually looked a lot better.
This time it's going to be opposite. Metals, etc. report later, and metal prices have been... But anyway, I mean, it's, there are no pure play producers, very few in India. Converters, yes, but we'll get to that in just a bit, right? Now, global stuff is, of course, in that sense, top of mind. It's not just global stuff in terms of US stocks, etc. It's also about what's happened with Indian stocks in the US. I'll start with not the global usual S&P, Nasdaq, etc., but with the US tech sell-off once again. And I don't mean the large cap, the Microsofts of the world, but the Indian IT tech sell-off that I'm talking about. So a software sell-off, let me put it that way. So Infosys ADR was down 5% yesterday. Wipro was down about 4.5%. Globant was down 7.5%. EPAM was down 7%. Accenture was down 4%. Cognizant was down 5%. It's a repeat. It just feels like deja vu from about 10 days back. Not even 10 days back. Actually, this was, I think, the sell-off started last Wednesday when we came in last Wednesday. It's been 1 week. And, a lot of these names are down sharply. Infi ADR and the Wipro ADR down as well. I mean, it's nothing new. It's the same stuff, which is anxiety that Gen AI is going to disrupt the business models. It's going to be deflationary. Pricing is going to go lower. And the effort required for delivering the same project is much lower, 20, 30, 40% lower, which means that pricing is going to be a problem. There are enough people who make the other side of the argument that, volume of work will expand, so that will take care of the lower pricing. But it's a debate which is ongoing, and the market will... it's tough for it. They're trying to kind of keep pace with headlines, also trying to price in some of these risks with not full information at this point in time. But, I mean, these are large cuts that we are seeing. If you can pull up the Infi and Wipro ADRs as well. Yeah, there you go. Those are the ones. So that's IT services, right? That's about 11, 12% of the Nifty weight. The other large pack is the banking pack, right? I mean, I think, 25, 30% of the Nifty, for example, is banks. And here, yesterday evening, RBI came out with draft rules. And this is against largely mis-selling. So RBI is striking against the basically push-at-all-cost sales culture in banks. There is a bunch of stuff, but basically one thing which I think is important is that it's stopping banks from sort of, bundling products together. For example, I mean, forcibly asking customers to take an insurance product if they want a home loan and things like that. There is a fair bit about, clear distinction between banker, agent, who can sell, etc., etc. We'll go into all of this in greater detail. But remember, and of course, I mean, the single largest third-party product which banks sell is insurance, right? I mean, anything which is long tenure-ish in nature, where the fee is quite high, right? I mean, in some cases, 20, 30% in the first year upfront fee. And that's a significant part. I mean, for many insurers, the banker channel is a big way through which they collect premiums. From a bank side, a third-party distribution, and that contains a lot of things, but that will be quite a significant portion of other income. So, again, something which we will talk about. So potentially slightly negative at the margin. This kind of stuff has been tried before. This is not completely new, but it's happened, so we'll have to take note of it. We'll see what the implications are. So IT and banks, I just wanted to sort of, put news flow around these two right up front. I'll quickly race through the global stuff now. So US equity indices went back and forth, ended flat. S&P, Nasdaq, Russell 2000, Not very much by way of change. The US jobs report was strong, and that's kind of weakened the case for rate cuts. Now, just one thing. The jobs report is, of course, by far very, very strong compared to the whisper number, expectations, etc. But if you look at the components of it, is it really as strong? The numbers are strong, but if you look at, for example, white-collar jobs within that report, I mean, that's not exactly very great. And I think people are starting to point that out over the last, 8-10 hours or so. Now, US two-year yields, they rallied, looking at the number. It's basically, markets pushed back the case for rate cuts from June to July. And they've also sort of lowered how much rate cuts to expect. I mean, those odds go down because the numbers are strong prima facie. So the 2-year went up 8 basis points, paid gains. 10-year closed up about 3 basis points to about 4.17%. Despite all of this, you have President Trump himself, Kevin Hassett, Scott Bessent, all three on record calling for lower borrowing costs, saying that America should have the lowest rate of interest, et cetera, et cetera. Of course, markets don't agree, and yields went up. Tellingly, the dollar, if you look at dollar, should typically follow what yields do. It did not. The dollar was absolutely flat, and it did not benefit from higher yields in that sense. The other gauge of risk sentiment is Bitcoin. It was at about 70, and it's basically sunk to about $66,000. Oil prices 1.5% higher. Intraday, they were up about 3%. I mean, I think markets are still very watchful of what happens with regards to the US-Iran situation. Now, the levels, basically, I said this yesterday as well, day before, you basically had an open and close, which were absolutely at the same level, which indicates exhaustion. Yesterday has not been very much different. Actually, yesterday is the third day that the market, the index, the Nifty pushed to up the 26,020 level and then sort of, sold off. So I think that is an important resistance in the near term, which the index has got to take out. The level on the downside remains the same, 25,450, 25,640, which is nothing but the gap zone, as we've indicated. GIFT Nifty gives you a quick sense of how we're likely to start, and then we'll pick it up from there, about 30 points down to begin this session. What is the institutional activity and the positioning looking like? Nigel has walked across to the wall. Nigel, take it away.
As you said, Prashant, last few days, we've seen some bit of consolidation in that 200-point range or thereabouts. And in terms of flows, the role reversal continues. The DIs, they were mild sellers, while the FIs, they bought close to 100,000 crores. Good to see the FIs back. They've stopped selling, and now we are seeing some positive numbers as well. So that's heartening to see. On the future space, well, they added my long positions in trade, as you can see, on the index futures. While in terms of short positioning, they added close to around 4 shorts for every one long position that we saw on stock futures. On the index itself, the short positioning has now moved to around 78%. That's a far cry away from the 92% we saw just a couple of weeks or so ago. Going to the options data then. They're writing both calls as well as puts, but they're writing more puts than calls. That's a positive sign as well. Well, since February 1st, the clients' long positions, they continue to remain net long. But the long positioning is down by close to around 60,000 contracts. So that's the kind of unwinding of long positions that we're seeing. While in terms of the FI positioning, well, their shorts have covered out by close to around 70,000 contracts. So both of them continue to remain at different ends of the spectrum, but the clients are booking some profits as the markets have moved up, while the FIs, they have covered their shorts because they were very, very aggressively net short. They continue to be writing, though, at a couple of strikes. 26,000 call, 25,900 put, both of them did see good amount of writing with the premiums ballpark at around the $100 odd mark. So plugging in this options data, looking at the technical levels as well, the 26,100, that's the near-term resistance that we're looking at. So, the bears will want to defend that particular mark. Well, support comes in at around the 25,750. That coincides with around the 50 DMA and around the 100 DMA as well. The 20 and the 200 DMA are lower out from them. Well, if the Nifty needs to move up, the Nifty Bank has been in 5 form. It'll have to do bulk of the heavy lifting since tech seems to be off color. So the Nifty Bank is the one that'll have to take us higher from here on. Being in some bit of consolidation, let's see whether or not the bulls want to push their way up in today's session.
Thank you very much for laying out the turf.